Good morning. Welcome to Stock Market Today, Friday, April 3rd, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get all the content or a lot of the content for this show. Also gives you daily stock ideas to consider, do some more work on. Hit your inbox every trading day before the market opens. So U.S. equities finished higher in Thursday's trading and closed near the best levels of the day. Energy, healthcare, and consumer staples outperformed. Consumer discretionary lagged, though all sectors finished higher on the day. Treasuries were mixed with the curve flattening. The dollar rallied against the euro and the yen. Gold was up nearly 3%. Crude oil, the story of the day, as there was back and forth about potential, and I stress potential, output cuts or an agreement between Saudi Arabia and Russia. That sends crude higher by about 25% on the day. So S&P futures are down 1.1% in Friday morning trading. That's ahead of the March non-farm payrolls report. Asian markets were mostly lower overnight, and European markets are trading lower as well. Treasuries are unchanged to slightly stronger. The dollar is seeing good gains on the major crosses. Gold is down 0.5%. WTI crude is up 2.5% after that 25% rally yesterday. So for me, for the S&P 500 right now, I think we are stuck between support and resistance. We've highlighted these levels. On the downside, initial support 2350. Below that, 2100. On the upside, 2650. We've been highlighting these levels for a while. We're stuck in the range. We really are. I mean, we're just stuck in the range. And if you want to frame up risk reward from here, well, you have about 125 points of upside to the S&P for, I don't know, about down to 2350, right? So, or even 2300, right? 2350 to 2300. You're looking at about 225 points of downside potential. So frame up that risk reward as the RSI holds bearish ranges and Chaikin money flow is bullish but flattening. Obviously well below the 50 and 200-day moving averages. So not a ton has changed despite all of that volatility. Still have a 50 VIX in the market. So what are we writing about today in our note to Chaikin Analytics clients? Well, the rally takes back some of Wednesday's decline, but the SPY sits between support and resistance. We just touched on that. Key themes continue to point to risk off. Semis are overbought with diminishing relative strength, and futures point to a lower open today. As it relates to the semis, that is a measure of our overbought, oversold indicator that we use at Chaikin Analytics. Taking a look at the power bars now for the major indices, Dow adds 2.2%, 0 to 7 bulls to bears, unchanged on the day. S&P 500 up 2.34%, 8 bulls, 142 bears there. So you can see still just a lot of carnage in the bull-bear ratios. NASDAQ up 2%, slight underperformer. 9 bulls, 24 bears there. And even in an up day, the small caps lag, 64 bulls, 487 bears. Bonds uptick, sending yields lower. Energy was your big outperformer on the day. XLE up over 9% on a 25% rise in the price of crude oil. However, remember, there's a technical component that shifts these ratios around. Even with this monster rally, still 0 bulls to 16 bears in the energy complex. Taking a look at our stock of the day now. This one's not auto-generated. I picked it because Vertex is a name that's getting a lot of attention, rightly so. Very bullish stock, and the power gauge rating is very bullish due to very bullish earnings, technicals, and expert activity. The financials are towards the bearish side, but when we take the 20 factors, 5 in each of these 4 categories, we roll out with that bullish rating. Strong trend above the rising long-term trend line. Weak industry group. All the industry groups are weak from a power bar perspective. Excuse me. So what I see here is a very bullish stock outperforming the market, middling money flow and overbought in the near term. So not necessarily a sign to go out there and chase it. I think if you're a breakout trader, you're watching this kind of 245 level here, right? Or if you really want to draw, if you wanted to draw the diagonal trend line, you have a breakout. If you're a horizontal guy or woman, you can look at 245 on the breakout. If you want to follow more for our process, you're waiting for an oversold condition. More than one way to skin that cat. You have to know yourself, what type of person you are, how you take risk in the marketplace. Regardless of that, Vertex's type of name you want to consider, right? a bullish or very bullish stock that's outperforming the market, and look at how well it's held up in the face of the bear market in which we currently find ourselves. So if you're looking for ideas, either for potential breakouts or to add to a bullish watch list, Vertex certainly fits the bill in that regard. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. Staples, healthcare, only two groups that are positive now over the last 5 days. So a lot of back and forth, green to red for this slide over the past few days. Energy, even with that sharp rally yesterday, is still down over the past 5 days of trading. Utilities, comms, and tech. Materials, energy, and materials, I'm sorry, real estate and industrials are kind of middle of the road. Discretionary and fins are lagging, and the fins just look awful. Rates continue to move lower. I gave a presentation last Saturday where I said I wasn't convinced that we've seen the low yet in rates. That does remain the case. Doesn't mean we're going there in a straight line, but I continue to see downside for rates, and that should pressure the financials, especially on a relative basis. Staples, still a defensive area of the market. We're actually going to take a look at how I view staples within this environment a little bit later on in the show. Taking a look now at our industry in focus, healthcare equipment services, which has been an outperformer, right? We've been talking about healthcare. We like healthcare, right? We're looking for the areas in healthcare that are potentially outperformers, and healthcare equipment services is it. Now, not from a power bar perspective because it's 3 to 12, right? It's weak there. But notice that 3 to 12 gets you the number 2 slot of the 21 subsectors we look at for this group that has outperformed the S&P 500 by 6.75% over the past 6 months. Now, names we don't want are Rhythm, IRTC, Mesa Labs, and Tandem Diabetes, TNDM. But we do want to continue to focus on bullish stocks and stocks that have bullish potential within the healthcare equipment services space, because I think that could emerge as leadership. All right, and here's why. Neutral plus rating. Trends weak. Outperforming the market, overbought, massively bullish money flow. So that is one of the areas of the market that we want to focus on because of the relative strength, right? We're watching the relative strength here, and look at the way the relative strength is really ramped up. So it held up fairly well on the way down, and it's ramping up on the way back up. Healthcare equipment, certainly one of the areas of the market where we want to be paying attention. Obviously on an absolute basis, it's under pressure, right? We're kind of differentiating between absolute and relative here. And the key point is that we want to focus on the areas that are showing relative strength as the market's weak, because they are potentially leaders when the market does eventually base and begin to move higher. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers. And this is really kind of an interesting one to me because it speaks to the fact of how much everything is moving thematically and together, right, with correlation to that theme, right? So yesterday's theme was clearly oil. Crude oil rallies 25% yesterday, up another 2.5% here in the early going on a Friday. And really the winner side of the board speaks to yesterday's activity in crude oil, right? Not a lot of company-specific news. Oxy's kind of an interesting case because they have an activist investor. Remember, Icon's in there. Stock did catch a downgrade today that I saw, but that stock was up nearly 19% yesterday. Diamondback Energy, FANG up 15+%. Helmerich and Payne, HP up 14+%. Devon, FTI. This is all levered to the energy space, right? These are all the energy names, and this is a bearish group for the most part. It's very news driven at this point, in and around production cuts or potential production cuts for crude. And really it's a function of you're either on the right side of it or you're not when these big one-day moves come. If these big one-day moves lead to a bigger trend change, then to me it becomes more interesting, right? Trying to handicap whether or not Oxy is going to pop on a news event that can't be forecast, that's a tough game to play. Loser side of the board, same thing, right? Very thematic. If you look at the loser side of the board, what is this? This is consumer discretionary with a leaning towards lodging and leisure, right? Travel, lodging, and leisure, right? Live Nation down, 12.5%. You going any concerts anytime soon in the middle of the COVID-19 outbreak? Probably not. Norwegian Cruise Line continues to be a disaster. The cruise ships are utterly amazing to me. And what baffled me the most is that there was actually a cruise ship with people on it who have COVID-19 that pulled into port yesterday in Florida. Just baffles my mind that these things are still out there, but they are. Norwegian Cruise Line down 12% yesterday. Coles, KSS hit a 52-week low, down 9.5% yesterday. Carnival, utter carnage in Carnival. And they did do a capital raise. They priced some debt and equity yesterday, stock down 9.43%. And Marriott, down 9% yesterday. I did see news on the tape this morning that they are tapping one of their credit facilities. Taking a look at the charts now, and this is actually one of the most interesting charts to me in the market. We're looking at a weekly chart of the S&P 500 here, and the reason it's interesting to me is because it really highlights the importance of that 2650 mark. Right? I'm just rounding it to 2650 to keep conversation simple. But if we take a look at the weekly chart here, you see the breakdown. Right, we've been highlighting fib retracement levels, right? We all know that this 2650-ish is the 38.2% retracement level. But what's interesting to me is that also lines up with the 200-week, right? This is a weekly chart. The blue line is the 200-week moving average. And it also lines up with the precipitously declining 5-week moving average, right? So, month of trading roughly, long-term 200-week moving average. 38.2% retracement level. Folks, that is a cluster or a confluence of resistance at that level. We've failed there twice on a weekly basis. Obviously, we're going to get the non-farm payrolls report today at 8:30. We'll see what that does for the markets. But to me, this is your level, right? This is the level you're shooting against if you want to be short. It's also the level you're risk managing against, because if we do get above it with this whole cluster of resistance, that's important, right? Not predicting, but just laying out a framework, right? If you want to be short this market, you're short against 2650 as far as I'm concerned, right? Under 2650, you can probably feel okay about the short. Obviously, a lot of near-term volatility. You have to manage that for your risk and what you can stomach on a personal basis. But I think under 2650, bearish the market makes sense, right? But it also serves as a massive risk management tool. Over 2650, well, you've taken out a huge cluster of resistance. That tells you something. Semis are at a key relative level as far as I'm concerned. I still place a lot of importance on semiconductors, and in fairness, they didn't tell the story on this breakdown. They did not break down relative to the market, ahead of the market. Nothing works 100% of the time. That doesn't mean we throw it out the window. I still think it's an important area of the market. To me, the fact that they've held up is pointing to the fact that Asia got this under control faster than we did in terms of COVID-19. Semis are, obviously a bit of an Asia play as well, in particular China and Korea. So if we think about that, in hindsight, it makes sense, but hindsight doesn't help us. The simple fact of the matter is, it didn't tip us in the U.S. But that's fine because now we're at a key level. We're above this kind of support zone, above the 200-day moving average. What's interesting to me is that we're testing that key level, but this high here was not confirmed. We have a series of lower highs for the RSI. On an absolute basis, semis look very much like the rest of the market. Breakdown, rally, starting to roll over once again. So we're still going to pay attention to the semiconductors. We don't throw it out. Bigger picture trend perspective, it's up. But it's at a key level right now. So we want to continue to watch semiconductors. And it's also important as to why we don't just focus on one thing in the marketplace. We pay attention to a lot of moving parts. And for us, back in late February, it was that gap breakdown through the 50-day moving average on the S&P 500 that told us, you need to be more selective here. You need to be honoring your stops. You need to be letting your cash levels increase. So it's a weight of the evidence approach. As always, you're building the mosaic. And then finally, I said we'd look at discretionary and staples. I'm classifying this as needs over wants, right? This is equal weight discretionary versus equal weight staples. So the stuff you want versus the stuff you need. And when the line is going down, it means the stuff you need is outperforming the stuff you want. Very much below the 200-day moving average, below broken support, RSI in bearish ranges. So some volatility. We did get deeply extended to the downside and then had the snapback rally, but still very much under pressure. In this market, investors are extrapolating into the economic environment and prioritizing the needs over the wants. It's going to wrap us up for today. Head over to chaikinanalytics.com /test drive. I'll be back on Monday.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.